Question. So most tax people will tell you, you cannot write off luxury goods, Rolexes, Lamborghinis, luxury goods, Birkins. If you were to write off the luxury goods, how would you create a defensible position so you actually have an argument to win the case? How would you create that?
Okay. So
what would you do?
I would first separate and have documentation of separating personal and business use.
So document personal and business. First off,
have an inventory log.
Inventory log.
Of, for an example, you buy a Rolex, an Hermes bag, a Birkin, things of that nature, and have a log of what they cost, or their status, their value, everything you need, the receipt, all the little certifications, whatnot. I personally would probably establish a safety deposit box. So now wherever that institution is, they have a log of when that bag was taken out.
Right. For personal use, and then when the times it was used for business use.
Or video content.
Right.
You need to also have some way of establishing how it produces revenue.
Why the Rolex or the car makes you more money.
Correct. Then you need to come up with an explanation for passing the ordinary and necessary test.
Okay.
Now, ordinary you can think, it's out of the question because it's luxury. But is it ordinary in your specific industry?
So this is ordinary, necessary expense in your industry.
And then necessary can be answered probably with the income revenue. If I needed to make this amount of money, now it could fall under necessary. And if you could prove that your industry normally uses luxury goods, it could be ordinary per industry.
Right. So it just depends on the industry and how you can prove that, right?
Correct.
Or is it ordinary for a real estate professional selling houses in Beverly Hills, or for them to be driving a Lamborghini? But
you might need your regular Toyota when you're doing your grocery shopping and all that.
So you would have to have a second vehicle.
Only try to use it for business. And if it comes to worse, use the business percentage.
So maintain documentation, business and personal use, inventory log, ordinary, necessary, expense, prove that. Coordinate with your tax guy to make sure you got all this in writing.
And be prepared for
scrutiny. Right?
Yes.
You give this like a 50-50 chance of possibly going through it.
And your first auditor will reject it. You will go to appeals. Appeals might even reject it. And you're going to take it to the IRS attorney's office, and might even have to take it to tax court.
Right.
But at least you have as much documentation. And worst comes to worst, they say you're inaccurate. They remove it. You pay the taxes and some penalties, but you tried your best to be as accurate.
The likelihood of this getting audited is what?
Depending on your business structure, it could be as low as 0.0001 to as high as probably 1 or 2%.
Yeah. So the chances of them asking is 1 in 100, 1 in 1,000, something like that. If you get asked, this is the steps of this is the most defensible position you can take, that you'd be able to write these things off.
Correct.
That's the way you would have the highest chance of writing luxury goods off. Correct. I know there's a lot of court cases, but if you can wiggle your rank or even get a reasonable an auditor that'll be helping you, then you can probably get it to fly through. We've seen some very interesting cases where we've been able to get a lot of things through that normally people wouldn't be able to.
And sometimes an audit is a negotiation.
Yeah.
The auditor is just trying to collect some money. So if you can agree with some things, they will allow others.
That was a short little explanation to how you can write off luxury goods.